Hello, Jim here. Selling options is a great way to make some extra income on a monthly basis. Now, there are definitely pitfalls and the right way and wrong way to do things. Today, I want to talk about a couple of those. I want to share with you some ideas to keep your account safe, keep your trading safe, and keep you from making big mistakes. So let's jump right in. I think you're going to enjoy what I have for you. Okay, I've been trading options for probably going on 12 years. I started with covered calls, moved into cash secured puts, and then vertical put credit spreads. And then to having started this journey of wanting to learn the right way to do it and then wanting to teach others the right way to do it and setting up these memberships that I currently have, I've kind of have seen it all over the last 10, 15 years. So today I want to talk about some pitfalls, some things to avoid, because I have noticed a lot of YouTubers recently are suggesting that you can take major risk and you can really blow up your account if you're not careful. Like I said before, I've seen it all. I've had members who have shared, where they have completely destroyed their account and had to start from scratch. I've also, I've had members and subscribers who have made mistakes, but I've been able to help them to potentially fix the mistake and, with minimal damage. So I just want people to understand that, you can definitely blow up your account. So it's important to trade the right way, to pick safe strategies, safe guidelines, and don't put too much at risk at one time. So the main pitfalls that I've seen recently, especially more so with other YouTubers, is putting too much into one stock, taking too big a chance on one particular play. The big name that a lot of YouTubers have been talking about is Palantir, and doing major numbers of contracts on Palantir. I like Palantir. They've been on my watch list for many years, and I've actually done trades with Palantir, but I minimize how many contracts I make with them. I also minimize how much risk I'm taking. I do think Palantir is a good company, but you shouldn't be putting huge amounts of money into it. Just like any other company out there, they can mess something up and it could do a major nosedive. One of the things I've seen over the years is accounting mistakes, meaning the accounting department at one of these companies has major issues and suddenly they can dive significantly over a very short period of time. So just don't put all your eggs in one basket. And that's why I believe, and I trade in a lot of different stocks. I don't pick one or two. I actually, for my membership, I send out typically on a Sunday morning, and today is Sunday, what I call my planning worksheet. And today I have 22 positions that are expiring June 21st. And, so I shared that with them. And I think there may be two trades on Zoom, and every other trade is different companies. And I believe out of that 22, something like 6 are in the money. What I'll do is I'll share that planning worksheet at the very end of this video. I don't want this video to go on too long, but the idea is to take less risk. Don't put everything into one company. Choose different companies that work well, and that's what I like to do. I also like to learn, quite a bit about the different companies. And like I said, I'll share more in some of the recent ones that I really like. Also, I believe people take too much risk with using margin, and I'm not talking about the margin. A lot of brokers will provide you margin in the sense that you can use spread, so you're really only at risk for the spread, But the margin I'm talking about is where you can spend a lot more than the cash you have in your account. You can take a much bigger risk. So instead of taking a $5,000-$10,000 risk, maybe you're taking a $20,000, $30,000, $50,000, $100,000 risk. Be very careful with margin because you can literally blow your account up. And if you get a margin call, you're working with hours or days of trying to rectify whatever the issue may be. Next, one thing I would consider is making trades that you do not understand. A lot of the trades that you can make out there can become very complex. I started with covered calls, and I did covered calls for many years. Then I moved into cash secured puts. Then I did vertical put credit spreads, but I also started with fewer contracts. So when I first started, and you can go back and watch my videos, I started with one contract, then I moved to two. And most of my trades currently are more like two contracts. I rarely have done more than two. Now, the exception is when a stock is very inexpensive. Sometimes I'll do up to four. I believe with Ford, I may have done even more than four, but you won't see me doing 10, 20, 30, 40 contracts. And sometimes people will gamble. I'd look at it as gambling, and they'll do one play and they'll up the number of contracts from 5 to 10 to 20. And it can really blow up your account. And I've seen it firsthand. I had one member who had invested in one of the banks that went under. And he was asking me, well, what can I do? And unfortunately, I think he had maybe 10 contracts on that one particular bank. So it can happen. So you have to be very diligent to protect yourself. I also, you know, making trades that you don't understand can really have a major impact, especially when you get into much more complex trades. Things like iron condors or butterflies or strangles and straddles. Really learn the basics until you start jumping on those. And you may decide you never want to get into those more complex advanced trades. I do a few more advanced trades, not many though. And you might argue that some of the trades I do aren't really advanced, like iron condors. I really do like iron condors at times. I also like poor man's covered calls, which can be a little bit more complex, but a lot of people would look at those as not being complex. Now, another important point is ignoring implied volatility. So it is a good idea to understand what's going on in the market and how it might impact your existing trades or the trade that you want to make. So keeping an idea of what the implied volatility looks like can also, help you in a number of different ways. Overlooking assignment risk, again, if you're doing multiple contracts and you're doing a lot of trades, I like to suggest that you always have enough cash. So if you have early assignments, that you aren't, putting your account at risk. I find that, on occasion, you'll have a number of early assignments. Typically, when you have like a correction in the market, you may see the market go down 10 or 15%. And in those instances, you have to have enough cash to cover it, or you're going to be forced to sell. You'll get a margin call and you'll be forced to sell some shares you don't want to sell. You might have to move money around. And if it's in a retirement account, it's even more difficult. It's more difficult to get money in and out. So again, keep an idea of, your how much could be early assigned. I also like to suggest to people to spread out your expirations. Don't have everything expiring on the same day. And then also go a little farther out. I like to go farther out. I'll go out to 90 days and I'll pick lower strike prices because of that and still pick up pretty good premium. A lot of people want to do weeklies or dailies. I typically will do, my favorite is more like a 60-day trade, somewhere between that 30, 60 days. Sometimes I'll do 90 days because, like ETFs, you can't pick up as much premium. So I'll go a little farther out and I'll take a little bit less risk. With the market so high currently, it's really important to take less risk. Ignoring expiration dates, again, is another big issue. Especially if you look at things along the lines of, dividend, ex-dividend dates, which can impact you on covered calls. If your expiration is around an ex-dividend date, then it could be in harm's way. So try to avoid ex-dividend dates when picking expiration dates. Same thing with earnings. I'm learning the hard way. I typically have not worried about earnings, but recently, like CVS kind of went against me, and I should have waited till after the earnings date. So I'm changing that too. So avoid earnings. Try not to have an expiration that crosses an earnings. At times that can be very difficult. Like, a couple weeks ago when we were heading into all the earnings, that became fairly difficult. Sometimes I'll go out like 90 days, so the expiration is pretty far away from earnings maybe a month out, because what you'll find is if the earnings really are really good, they'll shoot up, and then over time it'll trend back down. And the same thing if it's really bad, it'll dive majorly, like what's happened with CVS, and now it's trending back up. Failing to diversify, and this is what I was talking about in the beginning of the video. I like to diversify. Sometimes I think I might diversify too much. There's definitely a point where you can diversify and work with too many stocks and you can get yourself in trouble. I'm trying to limit myself to around 25 stocks, including ETFs, and trying to, that way you really get to know them, but doing the opposite and not diversifying, picking one or two or maybe three stocks or ETFs to focus on. Even SPY may be a little bit risky to a certain degree. Is too much risk on the other end. So to me, something around 20, 25 stocks and ETFs to kind of focus on, and pick your favorites and really get to understand how they move and how they interact with the market and earnings dates and expiration dates and all those other things. Another one is chasing losses. I've found this myself. Sometimes I keep rolling and rolling and rolling, and I miss great opportunities. So if you know you want to own the company, and I suggest don't make any trades unless you're 100% sure or pretty close to 100% sure that you want to own that stock. And if you do want to own that stock, then if it gets assigned to you, it's not a big deal. It's actually a good thing because you picked it up at a good price. Now, of course, that can change overnight or quickly if the stock goes down 10, 20, 30%, kind of like what happened with CVS, and I believe Shopify that also happened with. Ignoring tax implications. Again, if you're doing a lot of your trading in your taxable accounts, have an understanding of what the impact on taxes will be. Back in 21, when I was doing most of my trading in my taxable accounts, I think I added an extra 65,000 to my tax bill, and it comes at the end of your tax bill, meaning if you're making 80, you add another 65, that 65 is being taxed at the highest rates. Luckily, it's capital gains rates, so it potentially is lower. But I've moved most of my trading over to my retirement account, so that doesn't happen anymore. And I also keep track of it so that it doesn't majorly impact me. So it's something that's also very important to keep in mind. And then finally, keeping up with market news. What's changed about the company or the ETF? Has the management for the ETF changed that maybe you don't want to hold it anymore? Or has something changed with the company? Have their projections come down? I've noticed guidance has been a bigger issue with drops with different companies. Like their earnings may be somewhat okay, but their guidance will just blow them up. So just wanted to share these. We don't always talk about what can blow up your account. Next, I'll share with you what my planning worksheet looks like this week and what I'm sharing with my membership. So stay tuned. Let's jump into the next part. Okay, here's my planning worksheet that I released to my community or my membership earlier this morning. And it has pretty much all the different positions I'm looking to manage over the coming weeks. Now, I typically only list up to about 3 weeks before expiration, but I don't have anything else expiring until June 21st. So I went ahead and listed all my June 21st expirations. And I've noted any of the ones that are at risk in yellow. So it doesn't mean they're the only ones at risk, but currently they're in the money. Now, if you're curious about my memberships, take a look in the description. I have 3 levels. I have Investor Club, Traders Club, and then Coaching Club. I believe the Coaching Club probably is closed at this point. It seems like I have a couple people leave each week and then other people come in, and it provides some actual one-on-one coaching. The Trader Club gives you access to our every other week group meeting. You also get that in the coaching. You get everything in the coaching membership. But the Traders Club, you also get Discord. And then I have what's called an Investor Club where you can do it for a week for free. And then it does not have Discord access, but it has access to my Patreon. So you can see all my collections. You can see the previous group meetings. I do release them to the Investors Club. And then I have quite a bit of collections. I have like some training stuff that I did with getting started. I have 6 blog posts that I set up quite a while ago, and I've updated them. So you can take a look at the memberships. Again, they'll be in the description, and it may be worth your while to take a look. So, and as always, please subscribe, hit that like button. I'm trying to get the word out so people can understand how selling options can be such a godsend to you, and it can help you retire sooner than you ever thought possible, or just become financially independent so you can do what you want to do. So I release this every week, Sunday morning typically. I'm not going to go through each position, but you can see I had quite a bit. This is one of the most I've ever had, and these are all good companies. The only ones at risk are the ones that are in yellow right now. Polaris, which is about I think it's $5 or $6 in the money. I've been trading Polaris for a long time. I've made some really good money with it, and I'd be fine with owning it. So I've also got Zoom, WBA, which is Walgreens. It's been hammered lately, so this is one that I believe I've rolled down numerous times. But all the others, I have Apple, Airbnb, Best Buy. You know, again, I have another Polaris in my retirement account. I have Path, Oracle, Pure Storage, Tapestry, and Zoom. You know, all different companies that I like to trade. And these are current positions. So I list the short strike, I list the expiration, the current price. I provide quite a bit of information. And my members can use this if they're following my trades, or they can delete my stuff and put their stuff in. I also have my favorites. These are companies that I look at right now. The ones in green are ones I feel like are at a good price. They're not overpriced. The yellow are the ones I still like them, but they're a bit pricey right now. And the ones that are neither green or yellow are, you know, kind of in between. They're not overpriced and they're not too cheap. So I share this every week too. Then I'm working on this trade rankings, things I'm looking at to be able to rank my trades and be able to rank the companies. I have a checklist for looking, when you look at the company, what things you should look at. I have guidelines. And then I have my goals, which I update fairly often. I do feel like setting goals is very important. So just some of the stuff I share in these. And you can see how diversified I am. The main reason I wanted to show you this is I have lots and lots of different positions, and I have 22 that I'm showing here, but I probably have another 70 or so. I usually have between 80 and 90 at any time that's currently active. A lot of them are covered calls, which I don't trade very often. Again, I'm trying to double my dividends, so I'm not, and I'm also trying to keep the covered calls high enough that they're not being called away. So that's what I wanted to share with you. And I just wanted to kind of reiterate to people, be careful. It's not as easy and safe as some YouTubers make it out to be. You can definitely get yourself in trouble. And my hope is for that not to happen to you. Like I said before, I've helped different members who have gotten into trouble, and I've been able to help them get out of trouble, and I continue to do that. So thanks for joining me, and I look forward to seeing you next time.